Let us begin now with the Federal Reserve. As expected, no change in rates in the final meeting of both the year and the final meeting, guys, of the decade.
Come on.
But that's all in the past, guy. What should we expect in the future, in the new year? A rate cut, a rate hike? Steve Liesman was there. He was asking questions at the press conference, and he joins us now with more. Good evening, Steve.
Sully, thanks. The Federal Reserve ended a momentous year for monetary policy by launching what it indicated was a new regime, one where policy is likely to remain on hold for what could be at least several months. The move to neutral follows 3 successive rate cuts that began in August and a reversal of plans to hike earlier this year. Now, in the policy statement following the December meeting, the Fed called its current stance of policy appropriate. The Fed's overnight lending rate now standing at a range of 1.5 to 1.75%, and Fed Chair Jerome Powell saying that could be the case for a while to come.
We believe that the current stance of monetary policy will support sustained growth, a strong labor market, and inflation near our symmetric 2% objective. As long as incoming information about the economy remains broadly consistent with this outlook, the current stance of monetary policy likely will remain appropriate.
The statement said the Fed is monitoring global developments. That means it has its eye on the trade war and on foreign economic weakness in both China and Europe. While the chairman didn't rule out future rate cuts, he suggested the bar for hiking is high, as in high inflation. Powell said policy not on a preset course, but one sign rates could be on hold for a while. 13 of the 17 members of the Fed forecast no change in rates for next year, Brian. So you tell me, is that risk on or risk off?
Well, I can't, but I know our traders can.
I want
to ask you one more question, though, Steve, because we do get a change next year. I mean, you got some voting members out, you got some new voting members in because they rotate every year. How you know all the personalities. How much change or dissent or debate do you think that's going to bring with it in the new year?
You know, what's interesting this year we found, Brian, is that doves became hawks and hawks stayed where they were and some people moved to the center. People aren't necessarily ingrained where they are. I think only one, Esther George, remained on the kind of hawkish end. Mester moved towards the center. She was hawkish. I mean, I got to wait to see what the policy is to know where people are going to stand. But one thing we do know, which I think is a development worth talking about, is that I think Powell has control of this committee. This is policy that he supports, and the committee is not in a place that, A, he doesn't support, and B, that he didn't lead it to. And I think he's engineered. Let's talk about what happened. We went from planned rate hikes to, well, now we're going to cut, to 3 cuts to now on hold. All of that in a 12-month period. It's well to remember this time last year we had a 3% 10-year, and we had a forecast from the Fed itself that the funds rate would be 3% at the end of this year. Instead, cut it in half, 1.5%.
All right, Steve Liesman in D.C. It's been a long day for you, buddy. We appreciate it. Thank you very much.
Thanks.
All right, so with the Fed kind of seemingly out of the way for a while, what does it mean for stocks? We head into next year, Guy Adami, and also how much of this year's pretty spectacular gains have been Fed-induced?
This year?
This
How about
year.
the last 8-9 years Fed-induced?
This
year, I would say most of it, if not all of it. I mean, it's clearly not on earnings growth because you don't really have a lot of earnings growth. You don't have a lot of revenue growth. It's a lot on stock buybacks and the market's belief that somehow magically the Fed has their back. You know, I find it somewhat interesting that Paul Volcker passed away this week, and basically around the same time that the Fed lost any remaining semblance of credibility they ever had. And I don't want to get up on the soapbox, but, you know, the Fed talks about inflation. They measure inflation, everything ex-inflation, because if they really factored in inflation, it would far surpass any benchmark they had. But to answer your question, I mean, the market seems to want to go higher. I still think President Trump is going to pull the ripcord on these tariffs on Saturday night because in his mind, the Chinese are weak. They're vulnerable. The stock market's at an all-time high. I can step on their neck. Might cost me a month or so in the market, but by, February, March, I can turn this thing around, sets up well for the election.
Yeah.
So if you're hoping that things don't happen this weekend, I'm not convinced they won't.
Go ahead.
Well, that's the risk of this market, and I was surprised that the stock market wasn't higher today because you asked what's the impact on this. The Federal Reserve has had a very tough time, almost impossible time, creating the type of inflation that they want. But they're excellent at creating asset inflation. So that should be great for the stock market. So after today's reaction, and they're telling you, hey, we're going to run the economy harder, we want more inflation, you would think that equities would be much higher. But I think there's this trade war, trade tariff risk hanging over the market.
Why would anybody buy stocks this week, Karen, when you've got not only the Sunday potential tariffs, which we're going to get to more with Kayla, because Peter Navarro, the trade guy in the Trump administration, wants to go ahead with the tariffs. You've got this election in the UK tomorrow as well, which could determine, again, the fate of Brexit. There's so much risk out there. Why put more risk on?
If you feel like there's a little bit of risk priced in for tariffs, right? I don't think people think there's zero risk of the tariffs being in place on Sunday. So I think there's that. And also, we've sort of managed to earn through tariffs. The market's higher. Even with, we had tariffs this summer. We had tariffs in May. So ultimately, the market has been higher. I'm nervous. I think the VIX is up. I think that's telling you that people are nervous. 15, it hasn't been hovering around 15 for a while. So I'm long and nervous and have protection.
Yeah, so I think there's a lot more downside risk right now than upside potential. So I'm nervous as well. I think there's nothing wrong with holding cash. I see no reason to put cash to work prior to next Monday. We need to see what happens here, right? I mean, in my opinion, tariffs either get delayed or they come into effect on December 15th. There's not going to be a deal, right? When we talk about the Fed did a great job this year, right? 25%, the stock market's up this year, the S&P 500. But my concern is how much of 2020's performance did we pull forward into 2019? So now what should we expect next year?
Mark.
5-6% maybe? I mean, mid-single digits? I think a lot of the upside of next year has already been pulled forward. The Fed's off the table, so now what do you need to focus on? You need to focus on volatility surrounding the election. You need to focus on a trade deal. When is it actually going to go into effect if we get one? And you need to focus on the consumer, because the consumer's been the workhorse of this economy.